Hi everyone. So now I want to take you through one of the examples that I posted online. It's the company called Citrel, and we're going to go through the current rate method and the temporal method. And I will take you through the first year. So the first year in the example, I believe the example asks you to do 2014 and 2015. So you can do both, but I'm just going to do 2014 on the screen for now. So we're going to translate first our statements from the functional currency into the presentation currency. So whenever we're going from functional to presentation, we know that we're using the current rate method. Now, the functional currency that we have is in US dollars, and we're going to a presentation currency of Canadian dollars. I'm not going to put all the rates up, but I think the rates that I use at the beginning of 2014, the rate is 1.05. Then the average rate for 2014 is 1.02, and then the year-end rate is 1.09. So those are the rates that I'm going to use to convert my statements. So every time I go through the statement, you want to build your income statement, then you want to build your balance sheet. And in your balance sheet, you're going to find a plug for the translation gain or loss. And then you want to go and do the proof. So I'll show you how to do all of those three: the income statement, the balance sheet, and the proof for translating using the current rate method. So I'm going to start by building my income statement for 2014. And I have income before taxes. I really hope that you can see this and then the writing is not too tiny. And then you have income tax expense. Whoops. And then you have income tax expense, and that gives you net income. So my income, I always want to set it up as follows. I always want to put my functional currency, then I want to put my rate and my presentation currency. And if you want to draw little lines to keep it all neat and whatever, you can do that as well. There's no problem. So my income before tax is 135,000 and my income tax is 60,000, which gives me a net income of 75,000. Now, I know that my income was incurred evenly throughout the year. Why? Because they tell it to me in the question. My income was incurred evenly throughout the year, and if they don't tell me that my income was incurred evenly throughout the year, you take it as a given. You assume that the income was earned evenly throughout the year if they don't tell you. So my average rate, right, I'll use the average rate for the year to convert it, was 1.02. And this is going to give me 137,700 and 61,200 for a net income of 76,500. So now I'm going to leave this on the side and I'm going to go do my balance sheet. So I'm going to build my balance sheet as at the year end 2014. And remember, we're using the current rate method. So before I start anything, I literally just copy down my entire balance sheet. I copy down all of my assets, liabilities, and then I go and do my equity section. So let's do the assets. So I have cash, I have inventory, I have financial assets, I have PP&E less the accumulated depreciation on the PP&E. Then I've got land. Then I've got my liabilities. That is, I have other liabilities. I have my dividend payable. And I have my bonds payable. All right, and I think that's about it. And I like to have a line for my net assets. My net assets being my assets minus my liabilities. So now I'm just gonna copy everything down. So my cash is 15,000, inventory is 240,000, financial instruments is 322,500, PP&E is 318, accumulated depreciation on PP&E is 165,000, and land is 97,500. And my liabilities are other liabilities 60,000, my bonds are 60,000, and my dividends are 6,000. Now, we're using the current rate method. So if you remember current rate method from my previous video, which I did 5 minutes ago, but posted separately. If you remember, under current rate method, all of your assets and liabilities are at the year-end rate. So it's actually very easy. It's almost a joke. You basically multiply everything by the year-end rate, and our year-end rate is 1.09. So all of my assets, I multiply them by 1.09, and I'm gonna do the same thing for all of my liabilities. If you're wondering if you can add them up and if you can show them as one line, you cannot, okay? You actually need to multiply every single one. I know it's tedious, but it's not that bad, okay? You just need to multiply every single one and show every single line item. So my translated amounts, cash will be 16,350. My inventory will be 261,600. My financial instruments will be 351,525. My PP&E will be 346,620. Accumulated depreciation will be 179,850, and my land will be 106,275. Total assets should be 902,520. My liabilities will be 65,400, 6540 for the dividends, and then 65,400 for the bonds. Total liabilities of 137,340. And if I do all my assets minus my liabilities, I should have 765 and 180. I just like to keep this number aside for later. So now I want to do my equity section, and this is the most challenging section maybe apart from the proof, so it's not that bad. So equity, remember, everything is at historical rate. So let's set up equity. We have our share capital, then we have our retained earnings. And our retained earnings is always our beginning plus our net income during the year, less any dividends, gives us our ending retained earnings. The same thing for OCI. Our cumulative OCI balance is our beginning plus OCI income during the year, gives us our ending OCI balance. And then we have translation, okay? Now, one thing I want to point out is that, remember under current rate method, we said that our translation gain or loss sits in OCI. That's where it sits, okay? Technically, what you could do is, and I'll do it now just to show you, what you could do, and what you should actually be doing, is you should be putting your translation gain or loss in OCI, because that's where it goes under current rate method. If it confuses you to put your translation here, you can just take it out of OCI and put it on its own. You can give it its own line, but just remember that it sits in OCI, okay? But for presentation purposes, you should be putting it in OCI. Now, share capital at the beginning of the year was 495. In the question, it tells me that I started the company this year, so they make it wonderful. It's very easy. Beginning retained earnings is nil. We said that our net income was 75,000 from our income statement. I got that from here, right? And my dividends are 6,000 because I have dividends payable, right, of 6,000. So my ending income is 69,000. Now my OCI, I'm just gonna move this so everything is in line and I have space. This is my translation. So my beginning OCI, I started the company, is nothing, and I have OCI of 138,000. I don't know what my translation is, and they tell me that my ending OCI is 138,000. So my historical rate, because remember, everything in equity is at historical rate. My historical rate for my share capital is 1.05. My share capital was issued the day I started the company. So translated, that comes up to 519,750. Then my income was incurred evenly through the year at 1.02, and my dividends were declared at the end of the year, so 1.09 for end of the year. So translated, my net income is 76,500, and my dividends are 6540, which gives me net income of 69,960. And my OCI is 100, well, my OCI is incurred evenly through the year at 1.02. And so translated, it is 140 and 760. And all I'm missing is my translation gain or loss. And this is essentially a plug. Because at the end of the day, if we go back to COM 217, every single balance sheet, assets plus, I forgot the formula, but assets minus liabilities should equal your equity, which is why I took this sum over here. My assets minus liabilities comes up to 765,180. So my equity, all of this, should come up to 765,180. Right? If I add it up right now, if I do 519,750 plus 69,960 plus 147,660, it won't add up. It'll be off somewhere. So if I do the math down here, or if I just say it, if I take my assets minus liabilities of 765,180, I take away my equity, 519,750. I take away my income, 69,960, and I take away my OCI for the year, which is 147,660. I'm going to have a difference of 34 and 710. And that is my translation gain or loss. That's my plug. That's all there is to it. Right? And this is why I said, if you get confused putting it in OCI, just give translation gain or loss its own line. Sometimes it's easier that way. But at the end of the day, that's all it is. This is your translation gain or loss. And all together, if you want to know all together what your OCI is the sum of these two, your 147,660 and your 34,710, right? But now your assets liabilities should equal your equity. Now, this is a plug. This will always be a plug, but it's not really a plug. There's a proof behind it. And so I want to show you the proof behind it. So let's go look at the proof. So the proof behind it, give me a second here. So the proof behind it is, here it is. So the proof behind it is essentially looking at your change in net assets, all right? So this is your change in net assets. And remember, net assets is assets minus liabilities. That's net assets is just fancy for assets minus liabilities. So for your proof, you want to start with your beginning net assets. What is your beginning net assets? It's everything in beginning equity. You started the company this year. So at the beginning of the year, you had no retained earnings and no OCI. So the only thing you could have would be share capital of 495,000. Then you want to add any income you made during the year. This includes any income from OCI that you made during the year, and you want to deduct any dividends. So I had income of 75,000. My OCI income was 138,000 and my dividends were 6,000. Whoops, a little bit too fast there. 6,000. And that should give me ending net assets of 702,000. How do I check if my ending net assets are correct? Just like my beginning net assets is everything in equity, my ending net assets is everything in equity at the end of the year. And if you're ever confused, like if you're genuinely wondering, why is net assets equity? It's the formula. It's the formula at its base that you've been learning all along. Assets minus liabilities is net assets. That means that your net assets are equity. Why would you do all your assets minus liabilities? It's so much work. If you just add up your equity, it'll tell you what your net assets are, which is what we're doing over here. So if you look at your ending net assets, your ending equity, your share capital should be 495. Your retained earnings should be 69,000, right? This is your 75,000 of income less 6,000 dividends. And your OCI should be 138. 702 total, you see? So if these two agree, that means you did the math right. So now all you do is, this is in your functional currency. This is your rate. and this is your presentation currency. So now you just multiply everything. So this is at the historical rate. This is at the average rate during the year. This is at the average rate during the year, and this is at the year-end rate. So I will just translate them. This is 519,750. This is 76,500. This is 140,760. And this is negative 65,40 for a total of $730,470. So now what I want to do is I want to compare, right? My ending net assets, had I done everything at the year-end rate, had I translated all of my equity at year-end rate, what would my ending net assets have been? They would have been 702,000 times the year-end rate of 1.09, which is 765 and 180. There is a difference here. That difference is 34,710. And there you go. It matches. Where did my paper go? It would be great if I did have my paper. But that difference, here it is. Look at that. They agree. That's when you know that your plug is right, because you did the proof and you know that that's what your change is. Because if you look at it, if you look at what I was trying to show you before, under current rate method, your assets and your liabilities are at the year-end rate, and equity is at historical rate. The item that's throwing everything off is the fact that assets liabilities are not at the same rate as equity. So if you had made your equity at year-end rate, what would your equity be? Which is exactly what we do in the proof. We try to say, had we translated equity at the year-end rate, had we translated all of our equity at year-end rate at 1.09, what would it be? And what it would be versus what it actually is translated at the proper rates is your difference. That's your plug, all right? So that's your translation gain or loss. Now, there's one more thing for you to do, and it's very easy to forget because you think you're done the question, but you're not. Go back to where you started, which is in income. Your net income, you have OCI. So you have OCI from all kinds of other things that you earned during the year. And just give me a second, I'll explain this 138. And you have translation, OCI. So you can put them as one line. I'm just going to separate them so that you can see. I think it's 34,710. Yeah, 34,710. And all of these items together, your net income plus all of your OCI, will give you your cumulative income. Now, if you're wondering why there's two OCIs, why is there a translation OCI and why is there a regular OCI? Because a lot of you don't seem to understand the difference between OCI and translation. Translation is part of OCI. Understand that OCI is made up of many things. It's not just anything. OCI is made up of many things. Let's say that this 138,000 is OCI from a financial instrument. Go back, if you remember. Go all the way back to chapter 1. Let's say you had a gain or loss, right? And you were using fair value through OCI. That's what this 138 could be. It could also be something from revaluation surplus. Remember ACO 310? It could be from something like that. But what we're trying to say is your total OCI is this 147.60, the 138 translated, and your translation gain or loss. It might just be easier for you to separate it, but it's so important for you to remember that they are together, they're in one line. They should be in one line. It is OCI, but it's to help you understand that OCI at the end of the day is made up of many things, because a lot of you just seem to get confused with regular OCI, as I call it, and translation gain or loss, which is part of OCI. So that's the question. So to recap, you do your income statement, go up to net income, right? And you can even put in the OCI line if you want, but do your net income, then build your balance sheet, assets, liabilities at year-end rate. All of your equity should be at historical rate. Figure out your plug, which is your translation gain or loss, and then do the proof. And if you do the proof and your translation gain or loss comes up to the same amount as your plug, that means you did it right. If it didn't, well, good luck finding where you were off. You're gonna have to go back and figure it out. But once you find your plug, come back and put it into the income statement and then conclude what your total income is. And then that's it. That's how you do translation under the current rate method.